So then this still, we come back to this basic question: how do I decide how fast to grow my business? And I would be asked that question frequently by clients, and I never had a really good answer until I came across a formula, a calculation for calculating what's referred to as your sustainable growth rate. Your sustainable growth rate. So I hope each of you are on the page in your workbook. On the top of the page, it says calculate your sustainable growth rate. And if you would, read the top 3 paragraphs to yourself on that page under calculate your sustainable growth rate. Just read those first 3 paragraphs. So it tells us in that second paragraph, the sustainable growth rate formula tells us, everything being equal, how much sales can we grow over the next year without increasing our debt to equity ratio. So a little finance here. Debt to equity: debt is how much money we owe as a company. Equity is how much investment has been made in the company. And this ratio, debt to equity ratio, is what is referred to in financial terms as your risk ratio. How much risk does your company have? Because debt is considered risk. The more debt you have, the more risk you have. And the reason that debt is considered risky is, well, you got to pay it back. If you borrow money, you have to pay it back. And so that's considered a risky form of capital, because unlike equity, you have to pay it back. So debt to equity ratio is also called the risk ratio. And so what we're calculating here is how fast can we grow our company without taking on additional risk. Third paragraph: this is not the maximum rate of sales that your company can grow. So just like each of your cars are capable of going 120, 140 miles per hour, we don't drive that fast because it's not safe. So what we're calculating here is not the maximum speed rate of growth that your company could grow. We're calculating instead what is a safe rate of growth. Okay, so now underneath those 3 paragraphs, you see what looks like a very complicated formula. It is a complicated formula. Well, the good news is we're not going to use that formula to calculate sustainable growth rate. Instead, we're going to break that formula into several bite-sized pieces that will make it easy for us to calculate a company's sustainable growth rate. And so all we need are three numbers to calculate, essentially 3 numbers to calculate sustainable growth rate. Natalie, if you want to continue to go down that page, please. There we go. So number 1, we need to know what is our company's net profit percentage. We would get that from the income statement. Net profit percentage essentially is, if my company has $100 in sales and $10 in net profit, my net profit percentage would be 10%, right? 10 divided by 100. So number 1, we need to know what is our net profit percentage currently, again, as a percentage. Secondly, we need to know what is our debt to equity in terms of percentages. There are only 2 ways to provide capital to a business. We either have to borrow money or we have to invest money as owners. Only 2 ways to capitalize a business, to fund a business. And so what we're looking at here is of the money that has been put into the business, what percentage is debt versus what percentage is equity. And the 2 have to equal 100%, because only 2 ways to fund our business: debt and equity. And then the third component of this calculation is what we call variable asset percentage. This one's a little more complicated. On our balance sheet, as you look at your company's balance sheet, as you look at the assets on the balance sheet, some of those assets are what are considered variable assets. Now, your assets are stuff like cash, inventory, accounts receivable, equipment, furniture, real estate. Those are all assets. We'd find those on the balance sheet. Some of those assets are considered variable. Variable meaning as revenue grows, we need more of those assets. We call those variable assets. Revenue goes up, we need more of these assets. So a good example of a variable asset would be inventory. As our sales go up, we need more inventory. Another example would be accounts receivable. As revenue goes up in almost every company, your receivables go up. More people owe us money as sales go up. Variable asset, okay? So every company has variable assets. We also have what are called non-variable assets. Non-variable assets are assets that do not grow as a company's revenues grow. Do not grow. And so the best example I can give you of a non-variable asset would be a copier machine.